Okay, guys, welcome back to Macro Insight. Today is the 23rd of March, and let's talk about markets. So what's been going on? So what did we have? We had the FOMC meeting where Powell kind of came out at the margin more dovish, given that the market had been taking yields higher and had been starting to price in some tightening. He was pretty adamant that they were going to let the economy run hot. They massively upgraded their economic and inflation predictions, yet they still said they weren't going to do anything with rates because they expected, inflation to be transitory, and they were happy to let it run hot because they're now targeting average inflation. And so, on the day or on the evening, the market took that relatively well, right? And we saw a bit of a post FOMC spike in markets. So you can see here that spike from kind of 39.40 up to those highs. That was the post FOMC spike, but only to get sold the very next day. So that didn't last very long, as the market just kind of, I guess, then came to the conclusion that letting the economy run so hot isn't such a great idea, and they're gonna lose control of the long end of the bond curve or something, of the yield curve, things like that. And then finally, the big thing that we had been looking for an answer on, which was the SPR relief, that we didn't get any news on the actual FOMC meeting. We got the next day saying that they weren't going to extend that relief, right? And so you had an immediate sort of downdraft in markets. Yields obviously took out the highs on the Thursday, got as high as like 175, and then the market got a bit spooked there, and we touched lows of kind of 38.90 into Friday, basically, right? Now I had been thinking that there was a good chance the market might hold up before the expiry, but it seemed to be able, that kind of news was enough to get the market away from those upside strikes and to get down to that 39, just below that 39 level. Now, the slightly more surprising thing is over the weekend, we've come back stronger, right? For no real apparent reason. I mean, yields have stabilized, and that's the only thing you can really put it down to. And well, actually, there's two things, right? So yields have stabilized. And we'll talk a bit about why maybe yields have stabilized and what we think about that. But actually, the thing that's got the market a little bit excited is the Biden infrastructure plan now, right? So we've had the 1.9 stimmy checks all done there, and we're immediately now talking about the next infrastructure spending plan that's going to include, spending on clean energy, spending on infrastructure, on education, all of these type of things. And the numbers that are kicking around are like $3 to $4 trillion. Okay. Now, how easy that will get to be passed, they'll probably meet a fair amount of resistance from the Republicans. So we'll see. But those are sort of numbers that are being thrown around. And for now, the market quite likes that. If we bring up the chart on yields, here we are, right? So we got a spike up to 175, and now it's come all the way back to about 165. Now, if you zoom out a bit, clearly the trend higher in yields well and truly intact, right? But there's nothing to stop this thing kind of having a pullback, right? To maybe even 150 before it goes higher again, right? So then the market's going to be, we can see, right, the market's going to be quite sensitive to these swings in yields, right? So, I mean, it broke that channel, aggressively touched all the way up to 175. You'd have to think that an attack of 2 at some point is on the cards. But in the short term, we could easily retrace that level now is going to act as a bit of a support, I would have thought, around 150, right? So the new range is going to be 150 to 2. Let's see where we go first, right? I mean, it's kind of anyone's guess. Now, in terms of what might be giving a bit of respite to yields, despite the fact that SPR, because people were saying SPR, if SPR relief doesn't get extended, then that's going to mean banks can't hold as much. So they're going to supply more treasuries, to the market, and that's going to make yields go higher, right? Now, if you look at the price action in yields, that's not at all what's happened since that news came out. So that's telling you actually it's not as big a deal as the market had been saying. That's what the price action is telling you. And an interesting thing really for me is, I'm going to share this chart. So that gives you, right, the top one is Japan, the spread between 10-year treasuries hedged in yen against the Japanese 10-year government bonds. And then the bottom one is the US 10-year treasuries hedged in euros against the German government bonds, right? So it's basically telling you what the yield differential is between treasuries and Japan and European bonds once you take account of the FX hedging cost, basically, right? And you can see that the yields that we're looking at 1.13 and 1.17, these are levels that have not been seen for how many years, right? 2014, 2015. So that suggests that it's quite juicy and quite attractive for these foreign holders of treasuries now, right? So that's got to induce a bit of demand for US treasuries from foreign holders. That's the theory, right? So the fact that there hasn't been that much juice in treasuries once taking account of the FX hedging costs in that long, that, you know, I think that's kind of going to be your explanation to why things are probably stabilized, right? Now you've got auctions this week. You've got a 7-year auction on Thursday. So what will be interesting to see is, you know, what's the take up, what's the foreign take up, stuff like that, to get some read into whether yields are going to manage to just kind of stabilize and this kind of story kind of goes on the back burner a bit. Okay, so that's what I'd be looking out for. And you know, it's become quite a consensus view now, right? There's been nothing but yields on the radar, on the news, on the mainstream news for how many weeks now, right? That's all anyone's talking about. Is the only thing anyone who trades equities is looking at. What's going on with 10-year yields? What's going on with 10-year yields? So obviously that's become a bit consensual now that yields are going higher. It was pretty oversold from a technical perspective, and now we're getting a reaction off that, right? So, you know, I wouldn't read too much into the short-term price action. It seems like the trend is in place now for higher yields. And if that trend does play out over coming months, that's probably going to lead to a bit more turbulence in the tech sector, especially. But let's see if that happens, right? And then, you know, as tech has bounced on yield stabilizing, you've seen financials pull back, right? Financials started to pull back on that SPR news, and they've continued yesterday down about a couple of %. Okay, so that's been the main sort of price action we've seen around yields and alike. The other thing to mention is that the EU was talking about blocking exports of their AstraZeneca vaccines that have been manufactured in Europe, and they were going to block them going to the UK. Okay, so creating more political tension between EU and the UK. Negotiations are ongoing. There has been some easing of the words between Europe sort of overnight, so hopefully that'll get resolved. But the truth is, you know, EU COVID cases have been getting worse, and their vaccine rollout clearly hasn't been anywhere near as effective or efficient as the US and the UK. So this graphic kind of shows you, right, vaccine doses administered. We've got per 100 people, and that's been the progression basically, right? So you can see Italy, Germany, France, Sweden lagging miles behind where the US and the UK have come in, right? So that has been an issue for Europe. And, you know, probably something they are going to try and step up and address over coming months, right? For now, though, the European market doesn't seem to mind that much, right? Like Europe, you know, Europe's had been a bit of a laggard, but it's had a catch-up move recently in stocks. DAX there, you know, after it broke out of that big 14.2 level, stabilizing, and doesn't really seem to sell off with the market, right? If the S&P sells off, the DAX so far has managed to shrug it off, despite the fact that lockdowns have been extended through Easter, things like that in Europe. for now, the European market doesn't care. I mean, you've got the DAX is a bit of a special one. I mean, if you look at the Euro stocks, it's still pretty strong as well. DAX has got Volkswagen in it, and Volkswagen has been going a bit crazy because the market is kind of re-rating the EV potential of Volkswagen and how big it could be in EV and be a true competitor to Tesla. And I think that's the biggest stock in the DAX now. So that might be kind of distorting the DAX a little bit, making the DAX look a bit stronger than it otherwise would. But even if you look at the Euro stocks, I mean, the Euro stocks chart looks pretty firm, right? So just in general, Europe benefiting from the value rotation, right? It's got some financials in there. It's got some cyclicals in there. There seems to be a bit of a value rotation towards those type of stocks, obviously, and out of tech over the last month or so, and Europe definitely becoming a bit more in favor on the back of that. Yeah. And then the last thing about equities is Asia, right? So, Asia not having a great, well, when I say Asia, particularly China not having a great time, that's the Chinese market there. Looking pretty weak, kind of retesting local lows. The Chinese local index as well just dipped below 5,000, which is not a great level. Had been saying that, it does look like China's slowing down quicker or ahead of everyone else because they were the fastest to come out of this. So we're seeing their slowdown sooner. A question really is going to be how long before China comes in and stimulates its own sort of economy. But for now, they seem to be all right with the idea of letting things slow down a bit. Yeah, so that's something to keep an eye on. I mean, CS apparently downgraded Chinese equities. Their reasoning being that they think valuations are a bit high and slower earnings growth, basically, right? So a bit of bearishness coming out of Asia there, basically. India still looks pretty bulletproof. Have been saying I like India to buy on dips. Managed to pick some India up when it briefly got below 14.5. So that is still the one sort of EM that seems to be on an upward trajectory and behaving itself. Yeah, so I still like that as a hold for the longer term. Yeah. In terms of equities, I have been mentioning that I am a bit more bearish overall, just because. I think that I do think the story on yields is going to carry on. So whether it will carry on in the next week or two, who knows? I was thinking into the back end of March, timing wise, it made sense that, this thing would reach a bit of a climax. The expiry would roll off mid-March. The market would be a bit freer to move. But for now, it's not happening, right? I mean, we're only 2 days into this week. We'll see what the rest of the week brings. But, maybe that higher yield story needs to happen sometime in April. Maybe you have to push the timeline out a little bit. But I do think we see higher yields at some point, most likely around 2%. And I'd be surprised if the US equity market completely shrugs it off. But for now, it's trying its best, right? So let's see what happens. Yeah, I'm open-minded. Yeah. In terms of if we did get that downdraft, the kind of levels I was looking for on the downside on the NASDAQ were kind of around this sort of 12,000 to 11,800 area. I think that was like a decent downside target. That would also complete a nice sort of ABC correction for a fourth wave. So then we could start a fifth wave rally to new highs at some point. So technically that made sense to me as well. But like I say, it just might take a little bit longer to play out, right, than I thought. The thing that's kind of probably the most bullish thing at the moment out there is that the VIX is getting annihilated, right? So if you look at the VIX, it's threatening now. It's taken out 20, and it's question is where's it going to go, right? Because 20 had been holding for a while. If it can get down towards 16 to 18 range, then that, in theory, that's quite bullish for markets, right? Because that's kind of often a good sort of indicator of, where the markets are at in terms of sort of risk, right? So something to keep an eye on. Okay, so that's kind of where equities are on a global sort of basis. Coming up this week, what have we got? We've got a bunch of central bank speakers. We've got, so we'll see, you know, probably more chat, more quizzing about, you know, what I think that the thing the market kind of wants to know is they want more guidance from the Fed on like timing of potential tightening. They want to know how far they're going to let inflation overshoot and things like that. So, you know, whether they actually will answer those questions verbally or whether they will be forced to answer those questions by the market remains to be seen, right? But that's kind of what the market's going to want from the Fed over the coming quarter or two, okay? We've got Powell and Yellen speaking in front of the Senate about the CARES Act, but nothing new expected beyond what they've already said, right? So that there shouldn't be anything away from the script there, basically. So I don't think there should be anything to like move the market really in terms of new information on that. You've got some European flash PMIs coming out. We should see, you know, some signs of whether, you know, the European economy is relatively weak due to the slower vaccine rollouts and stuff like that in that data. You also got some retail sales data. You've got some German IFO business surveys at the end of the week. So those are sort of data points to look out for. Nothing massively sort of market moving, I don't think, out of any of that stuff. And then Biden, as mentioned, you know, he'll be briefed by advisors on his infrastructure bill, but the numbers being touted around a 3 to 4 trillion. So that at the margin, that's probably dollar negative, and probably a good segue to look at the chart on the dollar. So you had a bit of a dip in the dollar yesterday, but that did not last very long, right? So we bring up the short-term chart, kind of popped its head down to like 91.70 on the DXY, and we're back up again, right? So now the truth is the DXY is, you know, there's some major currencies that aren't included in the DXY. So in terms of the dollar strength, you do need to keep an eye on some of these emerging market currencies to see what the true dollar strength is, basically, right? Or whether other currencies are getting hit. And obviously you had the Turkey's lira got smacked yesterday. If I bring up a chart here. So it's a big old move from 720, briefly got as high as 8.5, settled around 790. So that's still 10% move there. And then you've got Brazil. So you've got a few of these EMs that are basically in the mode where their currency is getting battered and they need to hike rates to try and preserve the value of their currencies, right? So you had Brazil do that. You know, Turkey's been doing that for a while. But in general, you know, I don't think a lot of the time these policies aren't very successful, right? The currency is getting killed for a reason. And a lot of these people are firefighting and taking rates up, but all that ends up doing is screwing up their domestic economy even more because they're hiking rates when they shouldn't really be hiking rates, but they're doing it to try and protect their currency and avoid capital flight, right? So anyway, I mean, it's one to keep an eye on, but yeah, the dollar is becoming a bit stronger against some of these weaker currencies like Brazil, like obviously Turkey. See if Mexico's doing much. Mexico not really doing too much, but yeah, it's something to be aware of. I think Brazil probably might be the next shoe to drop here. So if there is going to be another EM currency that takes a bit of a shoeing, it wouldn't surprise me if it turns out to be Brazil. So as an entry point to go short the Brazilian real, I don't think this is the worst place to do it if you're that way inclined. But bear in mind, anytime you trade any of these EM equities, they're pretty volatile. They can be pretty volatile, right? So you need to make sure you size it appropriately and you don't get carried out, right? Because 10, 20% gaps are very possible in these things, right? So something to be careful about. Okay, so that is kind of where we are in terms of what I think about the dollar. Okay, so this is the oil chart. So got to highs, this is WTI, right? Got to highs of 68, corrected very sharply last week, got all the way back to kind of from 68 down to close to 58. I have started dipping my toes in on this. I think the long-term trend for oil is higher. and will continue to be. But there are some, you know, the big key support levels that I've got mapped out are around 57, 54.5, 51.3. So I've nibbled very small around here, and I'll probably add if we manage to get to those lower support levels, basically, right? But, you know, all part of my structural kind of wanting to get into commodities on dips idea, that's still intact. Now it looks like the dip is in place. Like a lot of commodities are correcting now. So it's one of those, you've got to kind of size yourself so that you can stay with the trade, and diversify yourself across the different commodities, basically, right? So that's kind of how I'm looking at it. So like starting to dip my toes into oil. Wheat also had a bit of a pullback. It's had a bounce today, but it got to quite a nice key level, wheat, in terms of the uptrend. So I dipped my toes in on wheat around 620. So that's, I don't know what that pop today is about, if there's any specific news on that. But like I say, in general, picking up dips in this stuff. Sugar had also had a bit of a pullback. Haven't really bought sugar yet, but soybeans and corn are kind of waiting. They're not doing much. They're still kind of up there, right? So would probably, you know, scoop some of those up if they did have bigger corrections, basically. Copper's been in consolidation mode. For me, 390 is a good entry point for some, and then 375 for some more. Like it did briefly get below 390, you know, back in early March, but it didn't stay there for long. I do think in terms of that correction, we could easily see that 375 level. That would complete quite a nice textbook correction as an ABC again. But we may not get that far. There's such a strong fundamental backdrop in copper story there. So we might struggle. I mean, it's just kind of trading sideways for now, right? We'll see if the China slowdown does gain some sort of legs, then maybe that'll be the catalyst to take copper lower, but I would definitely take that as an opportunity to own some copper over the longer term. Yeah. But like I say, 390, 392 and 376 are levels that I think are pretty decent entry points there. So that's kind of where we are in terms of metals, ags. So then it's just kind of gold. You guys know my views on gold. I'm a bear. I don't buy this rally in gold. Obviously, it's gonna have some sort of correlation with what yields do, right? So if yields are stabilizing, and really it kind of depends what real yields are doing, but if we assume that inflation isn't moving that much, then as you get a big drop in yields, you are effectively taking real yields down, which is good for gold. But like I said, I don't think that's going to persist for very long, right? So I think if yields are headed higher towards 2%, I think real yields are probably headed higher too. Apparently, if you look at the inflation break-even market, you can see what the kind of the yield curve looks like for the break-evens, for inflation break-evens, which are like your measure of market implied inflation levels. And basically what that is saying is that, just like the Fed is saying, they think inflation will be transitory, right? So the difference between the 5-year break-even inflation rate and the 10-year, it's telling you that, yes, you'll get some inflation, which is why the 5 years up here, or whatever it is, 255 or something, but the 10-year is lower. So it's saying that inflation won't persist. And so that curve has gone inverted, basically, right? Yeah. So, you know, I think real yields will go up over the summer as we get, you know, a bit of a spending boom, right? And that will be bad for gold. And I just think technically gold's at that point where, you know, you had 1760 as the level to break, and then it had a fairly quick move lower. I think that next level there is around that 1670, 1680. And if that breaks, then you get the carnage again, basically, right? Because there'll be a fair amount of people who don't think it's going to break that level, and that might lead to a bit of stops going off, basically, right? So I do think it's susceptible to that type of move, right? That I'm talking very much from a short-term, you know, 2-3 month kind of time frame. on a 2-year time frame, you are a buyer of these dips in gold, basically, right? So that's the difference. Because I like trading the shorter term moves and I want to trade those moves, that's why I can be bearish on gold. But if you're just a long-term investor, then you start allocating bits. You know, maybe you do a little bit around here, do a little bit around 16, 17, and you leave some powder dry to do it from an even lower level, basically. That's what I would do. Yeah. Thanks so much for watching, guys. If you enjoyed this video, then we'd love to have you join our Macro Insight community. Just visit www.options-insight.com and sign up for your free trial to our live and interactive weekly macro call. If you haven't already done so, please subscribe to our YouTube channel. You'll find more market updates, class highlights from our summer academy, and also video tutorials on anything from options basics to market making fundamentals. You can also connect with me directly. I'm on LinkedIn, Twitter, Facebook, Instagram. You can follow me on any of those platforms. Or alternatively, feel free to send an email to inquiries@options-insight.com. Thanks a lot.